Welcome to Global Tax Talk. I'm Shin Yamaguchi. We're in Singapore at PwC's Global Tax Symposium, where I'm delighted to be joined by Giang Chau, tax partner based in Vietnam. Welcome, Chau.
Great to be here.
So, there's been a lot of discussion recently around trade and tariffs in Vietnam. So I wanted to ask you a few questions around recent tax developments in Vietnam. First, as a general matter, where are we seeing Vietnamese tax policy going? Particularly in view of the government's desires to maintain foreign direct investment in light of the global trade disruption and other factors.
Thanks for your question. I think this question is often raised in the boardroom and investor discussion. First of all, we see Vietnam as a crucial turning point because we will see major tax reforms this year and next year, which cover key taxes, including value-added tax, corporate income tax, special sales tax, personal income tax, and also tax administration.
So across the board.
Yeah. The purpose of the reform is to enhance clarity, arrest the shortfall in the current regulation, and also maintain the growth. Additionally, there's also a major change in the restructuring of the General Department of Taxation into a new centralized tax department, along with the merger of various provincial tax offices. This initiative aims to ensure the consistency and also the central oversight. However, there may be short-term business disruption as they adjust to the new teams and the new processes.
Right.
In addition, there's also a major development, which is Vietnam's commitment to Pillar 2, global minimum tax. So a detailed guiding regulation has been prepared. The process for approval somewhat has been slowed down a bit due to a broader economic challenges, but there is a political will to move. So it's not a matter of if, but when. In summary, we could say that the Vietnamese tax policy is evolving toward greater transparency, alignment with international standards, and also more structured tax administration. So all of these initiatives aim to foster the growth and attract foreign investment. So I think it's clear for business to start to adapt now and maintain their competitiveness.
And to your point, given the significance of this tax reform, it's something that investors and businesses operating in Vietnam should keep a close eye on over the next coming months. Speaking of Pillar 2, I did want to ask you, given the introduction of Pillar 2 in Vietnam, do you foresee any changes to the preferential tax rates and also potential activity around non-tax incentives?
I think this is a great question because it reflects the balancing act that Vietnam is navigating right now.
Sure.
So in terms of tax incentive, Vietnam still maintains its tax incentive, including 10% corporate tax rate for high priority sectors. So this clearly plays a crucial role in order to attract investment. Yes. But with the introduction of Pillar 2, then it is clear that it may not be as effective to large multinational enterprise anymore.
Yes.
In response, Vietnam also consider other non-tax investment incentive. So this includes the investment support fund, which provides the support to operational and capital costs for qualifying investor.
Right, that was announced last year.
Yeah,
yes.
Mainly for those in high technology or R&D sectors. In addition, Vietnam is also considering other support as well, includes like the claim that the businesses can claim up to 200% of the tax deduction for R&D expense. And there's also potential grants to certain sectors if the businesses invest in like green initiative, digital transformation, economy's circular efforts. So all of these initiatives aims to maintain the competitiveness of Vietnam. So in short, Vietnam will not walk away from the tax incentive, but also consider all the non-tax investment incentives as well.
Okay, so especially in the tech and R&D sectors, but also more generally in something that multinationals, again, operating in Vietnam should closely monitor as to how that might apply to their operations going forward. So thank you. Lastly, one additional question on Pillar 2. What do you foresee in terms of the enforcement and audit around Pillar 2 compliance?
Okay, I think Vietnam is preparing early. We have seen the tax authorities sending letters to taxpayers requesting for information and data to assess the Pillar 2 readiness. In addition, last year, Vietnam also signed the mutual convention on agreement, administrative assistance in tax matters. So the MCAA
Yes.
is also a clear signal to show that Vietnam's commit to exchange information and also with the BEPS initiative. So in terms of the tax audit, normally it will take 3 or 5 years after the fiscal year end. So if Pillar 2 takes effect in 24, we could expect that the first audit will be around 27 or later. So in short, I could say that it's still early for the Pillar 2 enforcement in Vietnam, but the foundations are being laid both domestically and also internationally toward the greater compliance and effectiveness.
Right, so Vietnam did introduce the QDMTT effective 2024, and as you pointed out, they have taken active measures to be compliant with the OECD General Pillar 2 framework as reflected on in the introduction of Pillar 2 in domestic legislation. Thank you, Chau. So much going on in tax as well as the trade and tariffs in Vietnam. So please do keep us posted as we hear more around tax reform and Pillar 2. And thank you for joining us today.
Thank you.
And thank you also for joining us on this edition of Global Tax Talk. And come back soon so you say Global Tax Ready.